We're back for Module 21 of the Series 65-66 series, brought to you by Series 7 Specialists. I'm your instructor, Dan Morris. Good to have you back. I hope you're getting a lot out of these. Let us know. We really appreciate your comments, your likes, the things that you find that are helpful, what have you. So let us know. We're on page 31, about two-thirds of the way down the page, just talking about different types of orders, accounts, what have you. Just talked about a margin account, okay, and how a margin account, you've got suitability considerations. This is one of the things that you're going to really have to just revisit again and again and again, is suitability. And when you think about it in terms of suitability, what can go wrong? That's a good starting point, okay? You just don't want things to go wrong unless the people can handle what it is that eventually may go wrong in case they do something. So that leverage that we have in a margin account certainly has to be taken into account. It's a two-edged sword. It cuts both ways. An option account, the next one on the list, the option account is an account that's set up for options trading. Now, in the real world, you'll get an option agreement in your regular account, and it'll all be done in one account. If you wish to do so, that's fine. It's no problem. But, like I say, for the test, just think in terms of a separate account that's set up specifically for options trading. Options, you won't get tested a lot on this test. You may have maybe one or two questions. We'll cover that when we get to options themselves. But basically, just remember that options do provide, in some cases, they'll provide an opportunity for a certain gain, but an unlimited loss. And so again, they're very volatile. They go up and down quite a bit. There are conservative strategies. There are aggressive strategies. And just making sure that the suitability is there for each of the strategies. Spreads. The word spread in this industry always means difference. It's a difference between something. And so a spread is the difference between the bid price and the ask price, typically what you're going to see. We just talked about options for a second. There's a strategy in options called spreads, where you hope to profit on the difference between one option contract and another. But like I say, spreads in general always mean difference. And the difference that typically we're talking about is between the bid and the ask price. Now, it used to be that on the New York Stock Exchange, on the NASDAQ, that you had stocks that traded in increments of eighths of a dollar. And that was 12.5 cents. And that was great when we were in the 30s, the 40s, the 50s, and even the 80s. But then volume started to pick up, and as volume picks up, then your spreads tend to tighten. And that's why we went to decimalization, where we had stocks valued by the penny, and in fact in many cases you'll have less than a penny spread on highly active stocks. So the more activity, the tighter the spread. Less activity, less liquidity, then you have broader spreads. An efficient market is characterized by, there we go, high activity, tight spreads, thin little spreads. And so that's a marketplace where you know that if you just say, look, I just sell it for me or buy it for me, that someone somewhere there are too many players in the market, they're not gonna skin you just because you're the new guy that came into the marketplace. And the inside market is the highest bid and the lowest offer. The highest bid and the lowest offer. Now, I tell you what, in case you remember this, or have a question on this, and you have a little bit of trouble remembering which is which, just think about eBay. Okay, recently I sold something on eBay, and I threw it out there, and I had a certain offering price. So here was my offering price, or my ask price. Okay, and in their minds, some people were out there and they were saying, I tell you what, I will bid this much for something that I don't own. Now, if there had been a confluence of those, okay, if I had started out down here, then someone might have said, you know what, I'll pay that much. The next guy would have said, well, hey, that's a good price. I'll pay that much. I'll have a higher bid. I'll pay this much and that much. okay? And we'd have the highest bid. That's the one that would wind up actually winning the auction. The highest bidder, just like on eBay. My problem was nobody was willing to pay what I was wanting to offer the item for. So after listing it a couple of times and it come back unsuccessful, I thought, you know, all it takes is one bid and I get the thing sold. I'm going to take a lesson from the New York Stock Exchange and the NASDAQ. I'll put in my original offering or asking price, and then I'll come in every so often and I'll revise that offering or asking price by lowering it. And one of these days, because I don't know where this is, one of these days we're going to match up and we'll do a deal. Okay? So the first day I lowered it by that much. The next day I came in, lowered my asking price or my offering price again. Still no bids, no takers. Okay? Came in the next day. You guys get the idea. Finally, you know what happened? I lowered it to here, and this guy said, okay, that's a low enough offer. I will place my highest bid that I'm willing to place. I was hoping that somebody else would come back in and do this. They didn't. It doesn't matter. Only takes one bid on that matches to my offer to sell the item. It's a goner, okay? But like I say, just think about eBay. Who wins that auction? Well, it's the highest bidder. That's who wins the auction. With securities, you have a double auction where you have bidders and offerers that are trying to find that equilibrium. So like I say, just like when I lowered my offer, I eventually found a buyer. That's going to be the best offer, is that lowest offer. I didn't lower it again. No need to at that point, okay? So again, just kind of think about eBay, highest bid, lowest offer. That's going to be the inside market. That is, by the way, a dealer to dealer, merchant to merchant bid and offer. All right, they're going to mark it up or mark it down when they deal with the public. The next thing we go to over on top of page 32 is investment companies. And investment companies like mutual funds, like ETFs, like your closed-end funds, okay, just to name a few. In general, they can invest in any of the securities that we've talked about, okay? They offer the same objectives as the securities, so that if you have a bond fund, bonds are there to provide income, relative safety of principal. Bond funds are there to provide income, relative safety of principal. Like I say, if you have growth stocks, then that's fine. You can have a growth stock fund, okay, mutual fund or a closed-end fund. So they offer, like I say, the same objectives, and except as the way we mitigate it by diversification, they've got the same risk profile as each of the individual securities. Now, probably the best illustration of this was back in the early part of this century when you had the dot-com stocks that they took off. They took off, okay? And the thing is that they all got overvalued. And, you know, maybe a couple, three of them. But they just all got overvalued. And eventually that speculative bubble popped and, you know, the NASDAQ went down by like 80% or something like that. I can't remember the exact numbers, but it just took a huge tumble because the dot-com companies they blew up, okay? If I had an individual dot-com company as these things were going up like this, then if it was one of the ones that the bubble popped and all of a sudden people said, why are we even messing with this? They're not making money. They never will. Boom, I could have lost all my money. All right? So what I may have done is that I may have said, you know what, I need some diversification and I don't have time to research all of these little companies that have just sprung up with technology or with terminology that I don't even understand, technology I don't understand. Okay, so what I'm going to do, I'm going to invest in a dot-com fund. And so instead of one stock that's getting way ahead of itself, I've got 300 stocks that are way ahead of themselves. Okay? And the thing is that those dot-com funds, just like individual stocks did like this, a lot of the dot-com funds did like that. Now, probably not quite as hard because hopefully your management along the way said, whoa, it's time to blow out of these things. And they got out early enough to preserve some of the money. But a lot of the dot-com funds, you had diversification, but like I say, you still had that same risk because you were diversified within one group, within one sector. and that sector just got the guts cut out of it, well, guess what happened to the funds? Yeah, they got the guts cut out of them. Now, you probably had something left over, whereas if you had pets.com, you had nothing at the end, because you also would have had some eBay and some Google and what have you in the fund. Like I say, a little bit of toning that down. So you do have that risk reduction from diversification, but you still have the risks of the asset class that in general. Like for instance, if you have a bond fund, if interest rates go up, bond prices are going to go down. Whether you have individual bonds or whether you have bond funds, okay, you're going to see some losses in those regards. So that's one thing to keep in mind, is they'll act like the asset class. It's not a key to never losing money. Hopefully, if you lose money, you'll lose less, but it's not a key to never losing money. You can have a mix of asset classes for asset allocations. That's what we talked about with modern portfolio theory, mixing bonds, stocks, cash, international, domestic, large cap, small cap, value growth, all these different profiles that you can have. You can do that with your investment companies. And like I say, diversification. You may have just picked pets.com, but the fund manager is able to not only get that one that just blew up completely, but also to get some Yahoo, some Google, and what have you that did much better, some eBay that survived and eventually prospered. Professional management that again hopefully gets you into the right places at the right times, out of the wrong places as soon as possible. The convenience of investing small amounts. In order for me in 1999 to have invested in enough of those funds, those .com company shares, to have enough diversification to make it worthwhile, I would have had to have had a ton of money. But I could look at a mutual fund and I could get that diversification for $1,000. It's the same thing on municipal bond funds. You know, you need $5,000 for a municipal bond, but you can get a package of municipal bonds for literally in the hundreds of dollars, have that diversification in a unit investment trust, and so which is a type of investment company. So you can get that with a small amount. You have the income or convenience rather of reinvesting income, reinvesting capital gains. If I'm throwing in $2,000 into a municipal bond fund, for crying out loud, I don't need the income, because if I did, I'd need to keep that money in a money market fund, in cash reserves. So if I'm throwing it in there, then I want to take the income checks that come off of it, I want to take any capital gains I generate, and I want to just plug it back in. Think about your retirement plan, your 401k. What have you been doing with the earnings that it's created? Been plugging them right back in, and you can do that really conveniently in an investment company. Flexibility of switching from fund to fund as objectives or markets change, or as performance changes. I mean, one of the things that you probably have done with your own 401k is set up like an automatic rebalancing. And so what do? They just come in and they tweak the thing, take you right back to your original allocation percentages. Man, that's easy. Well, you can do that, and that is definitely an advantage of investment companies over individual issues, because it's harder to trade and more expensive to trade 1 and 2 shares until you get that huge dollar amount where it becomes less important. So like I say, you can switch back and forth, fund to fund, sector to sector, group to group, large cap to small cap to medium cap. Doesn't really matter where you're going from and to. You can do it very easily in investment companies. And then reduced non-systematic or selection risk. All right, non-systematic and selection risk, that's what we were talking about. If I had picked one particular stock and it's the one that blew up, the rest of the group did okay, man, that's non-systematic risk. Systematic or systemic risk, sometimes it's called, is where the whole system is ill. So all stocks go down, we have a general bear market, that's systematic risk. But the company I'm looking at, technology changes and it blows up, that's non-systematic or selection risk. You still have that systematic or systemic or market risk. And in particular with regard to investment companies, you have open-end funds. These are what we typically call mutual funds. They allow for their purchase and redeemed at a price that's based on the net asset value per share. And so this is basically what it is. If they were to sell everything today and distribute out cash, that's what the shareholders would receive, is that net asset value. And that's the starting point for the calculation. Now, yes, if it's a load fund, you'll add a sales charge to it. But it always starts, or it's based on. In fact, when you see based on, think of the words starting point. If the starting point is the net asset value. There's no market risk as related to the fund itself. Now, I'm going to just kind of put this on hold for a minute and talk to you about it again when we talk about closed-end funds, okay? So, the only risk that you see is the risk that the selection risk that they have, that they've reduced by virtue of the fact they're diversified, and the market risk that they have, of course, if they're good managers, bad managers, what have you. But that's the risk that you see, is whatever is associated with the assets that the fund owns. They may charge a sales charge, and it's important for you to know the sales charge structures and where they're appropriate, where they're inappropriate. All right, because investment advisory firms a lot of times provide advice on this. This is something where suitability kicks in. So Class A shares are the front-end load shares. Okay, these are the ones that kind of we know traditionally. And so what happens is, let me just go ahead and draw this out for us. Okay, we'll just look at what happens over time. Okay, and so with the A shares, what happens is that right here on day one, there we go, we're going to have a pretty good size sales charge. So A shares are in red, we'll just do that up here, and you have a sales charge up front, but then you have a fairly low ongoing cost structure as you go forward. Okay, there we go. You also have the ability to have break points in these things. Okay, where if you invest a certain amount, you'll pay the maximum sales charge, and then as you invest more and more, you reach break points, which reduces your sales charge. That's very important, because the thing is that these A shares are actually the most efficient for a long-term basis. If I'm going to be holding something a long time, I want to look at A shares because of this. Or if I'm going to be investing a lot of money, then what I want to do is that I want to look at A shares because of this. I invest the minimum amount, I'll pay that much, but then that will go down as I invest more and more and more, so that I can get breaks in my initial sales charge and have that efficient structure going forward. So those are our A shares. Like I said, we've got the break points, LOI, or letters of intent, ROA, rights of accumulation. Letters of intent, a 13-month period to reach one of these breakpoints. It's non-binding. It's basically, they say, mutual fund companies say, we'll take your word on it that you'll put in X number of dollars. If you don't, we'll just make it right. There's no punishment or anything like that. We'll just kind of backtrack and say, say that you didn't even though you did. Rights of accumulation, over time, I can accumulate this stuff, and eventually as it accumulates up and hits that breakpoint level, then from that point on I can get the breakpoint going forward, and then as it builds up to the next breakpoint level, I can get that breakpoint going forward. So those are rights of accumulation, suitable for large purchases or a long-term hold. Okay, we also have Class B shares. B shares, they're backloaded. Okay, so backloaded, you have a CDSC, or it's a contingent deferred sales charge. I like to actually change it and call it a contingent deferred surrender charge, because that's when I'm charged, is if I surrender the funds, cash them in. So here's the way it looks like, okay? I have 0% up front, so there's my B shares at 0%. However, I have the first year, the second year, the third year, the fourth year, the fifth year, etc. I just drew, however many, you have to check the individual fund to see what it looks like. And once you reach a certain point, Then what happens is that those B shares then convert over to where they're A shares, and they have that more efficient structure moving forward. Now, the thing is that if you're going to be redeeming it and you know that there's a good probability you're going to need it in these first few years, don't look at the B shares, okay? That's because you're going to get dinged when you pull the money out, and that's something that they really don't like to see, is to have your customers dinged for that contingent deferred sales charge. Okay, so basically B shares are for where you have an intermediate purchase, okay, that starts about here when eventually the surrender charge disappears, but doesn't go out forever, okay? So it just, to a kind of a fuzzy spot in through there. Call it 7, 8 years, maybe 9 years. So an intermediate term, not a long term, because over the long term, the A shares with that low cost structure, they've been shown to be the most efficient. Okay, you also have C shares, not on the outline. We'll talk about them just real quickly. They, like B shares, have 0 up front. Okay, they have. Oh, I forgot to draw one thing here, and that is that the B shares, in order to recover this, they have a higher ongoing cost structure until such time as they convert. Okay, so that's my ongoing cost structure up there. C shares basically have nothing up front. They have the highest cost structure, and they never convert over like that. Okay, so C shares would be if you have something that you need in a fund for a year, something like that. All right, and remember, you have those swaps back and forth in a mutual fund family. If you're going to have it in there in the family and just going from stocks to bonds to international to domestic to whatever, long time, the A shares are still the best. All right, and then no-load funds, they charge no sales charge up front. They can have, of course, obviously they're going to have management fees. You got to pay the fund manager, but they can have up to 0.25% or 25 basis points in trailing charges, ongoing charges, and still call themselves no-load funds. All right, so anyway, and then the expense ratio is the last on this. Is that the expense ratio is the ratio of the expenses to the fund assets, expressed as a percentage, and all factors equal, which they never are, all factors equal, the fund with the lowest expense ratio is the best. Now, here's where all factors are not equal. If I'm investing in treasury bonds, I'm going to have a very low expense ratio because there's always there. It's a very homogeneous market. All I need to do is just maintain the maturity structure that I want, maintain the coupon structure that I want. It's simple. I mean, I'll be finished by about 8:45 in the morning. But if I'm investing in a Botswana emerging growth fund, holy moly, I got to go over there every now and then, just check stuff out. I mean, it's easy for folks to lie on the phone. I need to go over and see stuff with my own 2 eyes. My expenses are going to be a lot higher than they would be in the treasury fund. All right, so there's that. Another thing, what do I do with the information I get as I manage? If we both have a comparable fund, I charge 0.1% more on my expenses, but I provide 0.5% more than the other guy in terms of performance. It's worth it. So like I say, all factors considered, go with the lowest expense ratio. That's where you need to read your question carefully, and don't argue with your questions. Because here's what I mean, the minute that you start saying, well, now what about when, I can think of a situation. Well, maybe, are they saying that? I think that what they're talking about really is, you're arguing with the question. First of all, you're doubling your work because you have to answer your own question, then you have to come back and answer the question that the question itself asks, okay? But the second thing you're doing is setting up yourself for a loss, because that's an argument you will not win. The question is always the question. You try to read into it, you're going to read too much. You try to assume out of it, you're going to assume stuff out of it that shouldn't be assumed out. Okay, so just take it straight up at face value, read it carefully. Don't argue with it, okay? All right, so anyway, we probably need to take a little break here, so let's cut off Module 21. We'll come back and talk about closed-end funds then, and we'll talk about that one point that I mentioned, that aside from what you regularly have with systematic and non-systematic risk, there's no additional layer of risk with the open-end fund. We'll go into that when we contrast it with the closed-end funds. So we'll see you back in a little bit. We really appreciate you visiting our sponsors, and let us know what you think and how we can help you out more. Thanks.